our mission is to deliver the feeling of home. So yes, we provide homes, but we're not looking to just provide the bricks and sticks where people live. We're looking to provide the feeling of home, things like stability, belonging, respect. And that doesn't stop at our residents. It goes on to our team members too.
Hello and welcome to the Froggy Five. I'm your host, Jim Fralick, founder and managing partner at Froggy Companies. And today I have the privilege of interviewing Jered Sturm. Jered, for those of you who don't know him, he is CEO of SNS Capital Group. They have 150 million plus portfolio in the Cincinnati area. They're out of Cincinnati, Ohio. Like I said, a multifamily group. Jered is a popular contributor on Bigger Pockets and a bunch of other podcast forums, other forums, and radio stations, which I found interesting. Of course, he's from Cincinnati, so the first thing I thought was WKRP for any old people listening. That was a popular show when I was a kid, but it's a fictional radio station. But Jered's been on all of it, and he's been doing real estate for over 18 years. For 6 or 7 years of that, he and his brother Andy founded multiple companies related to construction and investing in real estate. And he's going to tell us a lot about it if you haven't already heard him on other forums. And thanks a lot, Jered, for taking the time for our little podcast today.
Yeah, no, Jim, I appreciate the opportunity to, as I said before we were recording, anytime I can talk about real estate and business is a good time. So I still very much enjoy it and appreciate you giving me the platform to do that.
Yeah, absolutely. So let's jump into it. Unlike a lot of my guests, I don't know you personally, Jered. Haven't talked to you. I've seen you on a couple things before, but I don't know a lot about your story. So I think for my guests, I'd like to know, like, what was your platform? I think I saw at one point maintenance tech to owner of 150 million. So tell us about how you came to be in this position. Yeah,
I think one of the reasons why I've had the privilege to be able to be on a lot of podcasts is because I think my story is pretty relatable. Call it like organic grassroots growth. So going back to the beginning, in high school, I was not a good academic student, but I did really well in wood shop. So I had just a natural aptitude for the trades, kind of thinking, well, what am I going to do? I'm not really on this corporate path because the academics weren't my strength, but I can work with my hands. So the trades felt like a better option. And I was fortunate that my high school, my senior year, had the opportunity to work full time if you had enough credits, which I did. So I applied to be a maintenance tech for another local landlord here in the Cincinnati, Ohio market. And so I was the guy changing the toilets, painting the walls, hanging blinds, doing whatever was needed. And it exposed me to the real estate industry. I would say he was someone that me and my brother didn't intend to model our business after, but it did expose us to the rental industry because no one in my family was entrepreneurial and no one was in real estate. And so we kind of saw this opportunity that we said, both me and my brother have this skill set with the trades. Let's go ahead and try to use our drive and our skill set to then go into this real estate thing. And so what we did was first house we bought was a 6-bedroom house in not so nice of a neighborhood, but me and my brother lived in a bedroom, each lived in one of the bedrooms, and then rented the other 4 out to friends. And then slowly but surely began buying single family homes and renovating them and using our skill set in the trades. And at the time, lack of capital, we would substitute with sweat equity, and then have now built up to 1,400 apartments units here in Cincinnati, Ohio, over 16 years of buying in the market.
Wow, that is a compelling story, and that is a different path. Yet a great one, because seeing it from the inside out, coming in the other way is great for a number of reasons, especially if you're okay with property management, which I'm not. I'm on the opposite end. I envisioned myself having thousands and thousands of units and taking things from C class and making them B or B, trying to make them A or D, making them C. And, but when I watched my wife manage a few properties we were involved in, I quickly realized, based on my background and experience, like I didn't want to be part of that. And then maintenance wise, don't have a lot of skills. Like I ignored a lot of lessons my dad tried to teach me. He was a maintenance guy. He was an electrician, but he was also maintenance, like in our trailer park when I was a little kid. And so I had to go help him do all these jobs and forgot a lot of that stuff. And ironically, my son and I talk about it. We've had to build a lot of his log home in the property next to ours
Mm-hmm.
a couple of years ago. By default, we ended up, circumstance and the contractor hurt his back, and we were like, hey, we got to get this done ourselves. So we jumped in. So have skills to do some of these things, but so many people don't. Like a generation of people have lost the ability to fix things.
Mm-hmm.
And so I love to hear guys that like, actually, this is what I did. I worked well with my hands, and you saw that. So there's probably so many different opportunities. I wonder if you can give us a few of like where you've been able to create value based on your experience of and how you guys handle property management.
Yeah, I think everybody's core competency and what they can add value with is a little bit different, but certainly for us, I think it boils down to operations. So when I say that, I mean on-site operations, and we are vertically integrated to that. We've built our own company up to handle the property management and the construction of our 1,400 apartments. And so typically what we're buying to be able to execute on that core competency is distressed assets, and those assets will come in many forms of distress, but usually you can boil them down into poorly run, being property management, or needing renovation, which is the construction part. And so we've really executed on our ability to be best in class operators, leaning on the early skill set of the trades, and then slowly polishing it to build better and better processes around us. But Jim, we really have been doing the same business model since day one. We buy distress, we force appreciation, we strip the equity, and then we roll that equity into the next deal. It's just we do a little bit bigger each time, seems like.
Okay.
And so we've just kind of stayed in our lane, know what we're good at, and have gotten extremely good at now. Now we execute, I think it's like full apartment renovations. I think we do about one and a half full apartments per day now. So we have a team of over 50 people, and all of that's in-house where we're handling those renovations and doing well over $1 million in CapEx every year.
Wow, that's amazing. So, and you're all in the Cincinnati MSA. You're
Yeah,
sticking out. You're
going
trying to
back
grow out
to
from there at all.
going back to our core competency is operations. And my belief is the further you get away from home base, the more you lose that competitive advantage, or at least you risk it. And so staying close to home is what we see for the foreseeable future. When I say close to home, it's, our current properties are probably within a 50-mile radius of each other. And so those familiar with our market, we do look in Cincinnati and Dayton is to like 45 minutes to the north of Cincinnati. So
Sure. Yeah, but don't go across the Kentucky side at all. Or have you thought
we
about that?
would, we just haven't.
Okay.
And a lot of times it just matters what else we own in that area or what size asset we're buying, right? So to throw a new property a little bit further out, it needs to be pretty large so it can self-sustain. And then we can bolt on smaller assets to those operations should we want to grow off of it.
Wow, fabulous. So 50 people. So you got a big operation running there. Now, yeah, I've got a number of questions based around this because this is really good. I'd like to hear about people who are just expert in a geographic area and a business model. And so I wondered, so do you do any things for other groups? I think Joe Fairless is a Cincinnati guy. I'm not sure, but and so I know he owns a lot of stuff. Like, if any interaction, so people come to you and say, "Hey, would you manage X properties, or would you renovate these?" Or at this point, are you're just full of just your stuff?
So we have no intention to do third-party property management. So
Okay.
we only
The
manage what we
I
own and control.
so getting me
I think property
from there,
management is the most important,
philanthropical.
least fun, least profitable side of real estate investment. So because it's, in my opinion, the most important, I'm willing to put forth the effort, but I don't want to do it for other people because it's not profitable and it's not fun always. So
Well said.
and so yeah, just our assets, and we only intend to ever do that. So both from construction and property management, we just do internally. So I don't want to have to worry about insurance and other people's properties and their kind of preferred specs and all that. We just do the same thing over and over and over.
Wow, that's
Um,
great.
and as far as you mentioned, Joe's a friend of mine, has been for a decade. Um, and so we live very close to each other. Our kids go to the same school.
Oh
Our
wow,
wives get along, and we've been on bowling leagues, go on camping trips, and so certainly see Joe as a really good friend.
wow, good. Yeah, so I wouldn't want to come in and try to compete in Cincinnati with you guys there if I was trying to get a value add thing, because it would be like, hey, these guys are on top of. Um that's what you need to gain an advantage in an area like
Mm-hmm.
that big in the value add market, especially, right? A lot of people, when it was easy, a lot of people came, and I would like your perspective on this. I've only been doing this 6 years. Have done some value add. I have partners that have done a lot of value add, and some here in New Hampshire that are doing it pretty well at a lower level than you. I would say we don't have tons of multifamilies in New Hampshire. We have a lot more smaller multifamilies across the state, but um, the but a lot of people that did it have gotten themselves in a tough situation with commercial debt and stuff, right? They lately, this is my perception from getting hundreds of deals across my desk and placing equity for other people, um, and seeing a lot of the same stories again and again, and then seeing now where people are at. And so a lot of the, it's shrunk, I guess, in terms of the value, right? It's hard to find good deals right now for most people. I'm wondering what your perspective is on that. And that, have you guys run into any specific challenges I'll just say in the last 24 months?
Mm-hmm.
If so, what does that look like?
So quality deal flow has always been a bottleneck because we're so geographically focused, right? So we feel we have the operational capacity to take on significantly more units than we have. So if market conditions and our efforts align to be able to allow us to acquire 1,000 units, 1,000 more units, we feel very comfortable being able to do that in a short period of time. But our actions plus the market haven't aligned for us to be able to do that. So we're continuing to look, hoping that market conditions will open up, or we find a new way to find opportunity within the current market conditions, right? It's just the combination of those two things. Challenges within the last 24 months. We were very fortunate. If I go back to our investment philosophy, what SNS does is we focus on consistent, predictable cash flow. Right. So the Cincinnati market caters to that. Our business model caters to that. And then very importantly, our debt has always catered to that. And what that means is if you look back over our years of buying, we have used primarily long-term fixed rate debt because the assets that we're buying support that. And the business model we're targeting, which is usually like a 10-year hold period, also supports it. And so, going back a decade, we've been putting mostly long-term fixed rate debt on everything. So when you combine long-term fixed rate debt with rock solid operations, which I believe we have, those two things, in my opinion, make a pretty bulletproof recessionary environment. So Midwest multifamily C to B class properties with fixed debt, with a best in class operator, we have fared pretty well. And I think we will continue to fare pretty well. And, maybe we pay a slight reduction on returns for that predictability and that consistency. But in hindsight, it was a very good move.
Okay, great. So given that, have some of them been, have you done any HUD, like 221 or 223 in the case of existing, or nothing like that?
No, mostly agency debt, Fannie Mae, Freddie Mac. A lot of times we'll buy deals with regional bank debt when they're highly distressed. But even with those, usually we'll put longer term fixed rate in case we can't get out of them. And then we'll transition to agency once we've stabilized.
So you've probably built up a few reliable lenders in your area now that you've got this portfolio, especially, right?
Yeah, I mean, I think 16 years, and my biased opinion here, but having a good reputation to be able to do the job really well. And I think to illustrate that, a couple of years ago, we bought a 246 unit foreclosure no financials whatsoever, right? It was coming out of foreclosure, so there wasn't any financials. There's about 100 vacant units, at least that we were aware of. Not even keys. We didn't even have keys.
Oh,
And
wow.
so to get a lender to finance something like that takes a lot of trust and a decent reputation. And we were able to do that. And we did really well with the project. But yes, strong lender relationships that allow us to execute on the value add strategy, but then also really strong relationships with our investor pool. So on the equity side, being able to raise money, people who believe in us to be able to execute there too.
Yeah, I bet. Are most of your investors regional as well? Like how now? I would sort of shift the conversation. I'm going to ask you a technology question and some
Okay.
warning and some deal specific stuff. But I'm curious from your operational standpoint and scaling standpoint. You seem to just be solidly vertically integrated, organic. When you switch to the investor side platform, and I went on your site. I'm trying to remember now. So Appfolio, I think you use, right,
Yes.
for your investors. So now, so you have obviously been syndicating some level of money.
Mm-hmm.
What's your what's your metrics? Like how do you roll in that way? Do you do JV partnerships? Is that also everything just your own? Did you start with family and friends and then grow a set of people? Is it all Cincinnati people, or how do you?
Yeah, let me go back to the beginning just to give some context on like when we made the decision to use the syndication model. So, we've been doing this 16 years. The first 8 years was exclusively with our own capital, just us buying, forcing appreciation, stripping the equity, redeploying into the next deal, and slowly
Mhm.
but surely buying larger and larger assets. So, it was 8 years of proving that out and building the operations and building the foundation that then we were comfortable raising money from outside investors. So the second 8 years of our story, the second half of the story, we did use the syndication model. It's a whole nother business that you're bolting onto your business. So there's a ton of responsibility and you want to make sure you're being able to do that right. We have a third partner. So it's me, my brother, and Coleman. Coleman's background, he's a CPA. He has his master's degree in accounting. He did financial reporting for a multi-billion-dollar real estate firm where he reported to their investors. So he
Okay.
brought an institutional grade background of investor reporting into our smaller kind of boots on the ground operational organization. So it's a great partnership and couldn't have done it without Coleman. But to answer your questions, they are full blown Reg D offerings for syndications. It's not joint ventures, and so there are passive investors, and then there is the general partnership, which is our company SNS Capital Group. So our structure is pretty straightforward, typical. I'll rattle it off, but let me know if you want me to break it down. But 70-30 split of equity. So 70 to the
Mhm.
limited partners, 30% to the general partners. We have an 8% preferred return, um, and no complex waterfalls or anything like that. And pretty straightforward on the structure, and have had really good luck of just performing well and having a lot of repeat investors come back.
Yeah, pretty straightforward. Sounds pretty right down the fairway. What a way to build a business. You phenomenal story and blueprint. I'll say a blueprint for people who are on the ground that are interested in, that understand
Mm-hmm.
the maintenance side of it and the construction side and could start from that level, which isn't a big that shrinks down the pool right there from the angle you came at. But if people are in that and at that level and know an area, that seems like such a great way to build up a business. Probably tons of lessons, and those are all. Well, side note question: 506B or 506C or mixture in terms
We've
of how
done
you
exclusively 506C.
got it.
And
So
you had
you,
another question earlier that I didn't answer. So me and my brother and Coleman have tremendous upbringings. We have great parents, super supportive, but not entrepreneurial. And just our networks starting out were not the accredited investors that had the capacity to participate in these types of deals.
mhm.
And so it's not many people in Cincinnati. And I would not label the majority of our investors as like friends and family. But what what we were able to do is build up a reputation in those first 8 years where some people reached out and asked questions, and we, took down their names and said like they had expressed the interest that they would want to invest if we were ever raising money. And we started out small. I'll give you an example. The first syndication that we made the decision to syndicate was a 93 unit multifamily. And keep in mind, we had already built up a decent amount of success and got started at a very good time in the market to do so.
Mm-hmm.
So we were cash flowing strong. We had pretty good cash reserves. I put together the offering memorandum for our first syndication. I sent it to one investor who had expressed interest, and I said, will you just give us your feedback on this packet, right? Before we send it out to everyone, I just want a different set of eyes on it. And he emailed me back and he said, if you take half, I'll take half. And we said, okay, done. So we started with our first syndication was one investor. So it would have been very easy for that to just be a joint venture, but we didn't structure it that way. But then it went to a little bit bigger pool and a little bit bigger pool. And through word of mouth, it has spread. I would say that the majority of our investors are either in the coastal markets, the Sun Belt, or out of the United States. So it's all just through word of mouth and kind of just doing a good job. And someone says, what are you doing with your money? And they say, oh, SNS is producing these great returns for me. And they say, can you make an introduction? And over enough years, that pool continues to grow.
That's great. Outstanding. So let's get into a few. Let me ask technology before I leave it, because some of my discussions lately have been about technology. I have a systems engineering background, so I'm big on technology in a way of trying to stay on the forefront of what's happening, which is very difficult now because there's so many different options for CRMs and different AI tools. And I mean, you guys are on the construction side, which I assume has been all value add. Or do you do any ground up as well? Have you done any? If you see a piece of land, no,
we haven't. No.
Okay. Because the metrics haven't made sense to you, right? I mean, development's more risky too, right?
I think we'll get there eventually, but we just focus on what we're really good at and what our processes already accommodate, which is not ground up development.
Gotcha. Okay. So mostly what I've been involved in the last 6 years is ground up development for whatever reason, mostly because limited deal flow in terms of seeing value add. So if you can build it to a better cap rate, but I want to know what you think about technology, because you guys must be on top of this. How do you view changes? How do you utilize technology? What kind of changes do you see? And are you excited about anything happening on the forefront that's making your business more efficient on either side?
So we're a huge believer. Well, let me take a step back. I would say our industry, which is real estate investment, and probably I would label mine as property management, in my opinion, is like archaic when it comes to adoption of technology, right? We're like 30 years behind. I don't know why, but half of our market still uses printed paper for work orders. It's like, how is this 2024? So we are very adamant about using, data, collecting as much data on the back end as we can, aggregating it, organizing it to then make bigger decisions, and also acknowledge top performers in our organization. So we're adamant on that. But I will say that I have seen a lot of prop tech, things that come into the market to help us use technology more. And I think the mistake a lot of people have made is it's not a substitute for just general execution. First, you have to lay the foundation of just executing correctly, right? Like you got to pick up the phone and answer the phone. You got to respond to the email. And then if you want to bolt on these additional tools that make you a little bit more effective, then great. But they're not substitutes. And so I would say our biggest takeaway, especially in the property management industry, is we need to be able to boil everyone's role down to 3 to 5 KPIs that we track. Those KPIs need to be driven by true data and metrics that's being stripped out of the inputs that are going into our property management software. And then we're writing scripts to then scrape that, organize it, and present it to praise what we want repeated. And so that praise comes in just general praise, but also in compensation and raises and advancement. And so we are adamant about knowing what's going on from a data and metrics standpoint in our business. And I would say that's like normal business today, but for whatever reason in property management feels a little bit advanced.
Yeah. No, well said. Well said. Not enough people point that out. We've had a lot of talk about AI recently, and automation of manual tasks, which, like you said, in real estate could be tons of things, especially with like title work and just the way things are put together. You're right. It's archaic. A lot of people are trying to move ahead, but we still have this gap between people that are using like whiz bang technology. Some people are buying into it, spending a bunch of money, but like you said, you can't bolt that on to something that's not already functioning well. You need to be functioning well
Mm-hmm.
before you take really well functioning manual things and try to automate them. I see people making mistakes with that again and again
Mm-hmm.
on both the construction side, construction management, and property management side.
Mm-hmm.
But I like how you said you boiled down some of those key performance indicators, KPIs of I guess each role. So it sounds like you've tell me if I'm wrong, but you've defined roles both on your construction and property management side pretty well enough so that you can attach to someone's job those things you expect them to perform well at,
Yeah,
right? And
for
you
sure.
give extra compensation or rewards based on that.
Yeah. Yeah.
Okay.
And just hold people accountable. Right. And I can dig into that a little bit, but I would even start with an overarching statement that a lot of people are attracted to real estate investment and these podcasts because what we're seeking is the financial returns and freedom that real estate investment can produce. But
Mm-hmm.
what I think a lot of people miss is the financial returns are supported by the on-site operations, and the on-site operations are 100% produced by the people who work there, right? And so knowing what they're doing and how to hold them accountable to the standard that then will trickle up to the financial returns is vital for the overall investment performance. And so that's what we've done over 16 years is reverse engineer the property management company that can support the financial returns, and something that, I'm super proud of. And a lot of people like shake their head of like, how do you do this? Right. So we have 1,400 units. We have, I think 5 large apartment communities going through repositioning right now, full renovations. These are large apartment communities. So hundreds of units going through this repositioning, and our occupancy rate is 99%. And it's like, how do you
Wow.
do that across 1,400 units while repositioning? It's like you dial in on what everyone's responsibilities is. You get them to work together and you hold them accountable to that. And so, super proud of the results that we've had and the KPIs. And I'd be happy to give a specific example of a certain role if you
Yeah.
want to ask
Yeah,
about.
do it. I want to first say I would like you to do that, but before that, I'd like to say that's a stellar approach. I mean, the things you're talking, there's fundamentals of running a business is what you're essentially saying. I don't know if you've ever heard of Stephen Covey. It might
Mm-hmm.
be before your time. I don't know if he's still writing. People are still reading that. But what was it? The 7 Habits of Effective People. But one of
Yeah.
his main themes in there, if I remember right, I got to think back 20, 30 years, but was the production capability. Like too many times people, for lack of a better word, like crap on the production capability, the goose that lays the golden egg, which is the workforce of whatever you're doing, and it gets lost so many times.
I can relate to what you said there and appreciate the kind words to say you can sense that we treat people well. All over our office, all over our website for our property management company, which is where most of our employees work, it clearly states our mission is to deliver the feeling of home. So yes, we provide homes, but we're not looking to just provide the bricks and sticks where people live. We're looking to provide the feeling of home, things like stability, belonging, respect. And that doesn't stop at our residents. It goes on to our team members too. Right.
Yeah,
So if you as an organization are embedding into the core values that we're delivering the feeling of home, you're going to have better retention. You're going to have better overall outcomes of the productivity and profitability of your company. But to piggyback on that and tie it into the KPIs, like I'll just pick my story starts with maintenance tech, and it's an understandable position. So I'll start with that one. In our industry, for multifamily maintenance technicians, if you go to a property management company and you say, how do you know if that maintenance tech is good or bad? Like, the answer is, if he has work orders backed up, he's bad. And if he's cleared his work orders, he's good. Right? That's the level of sophistication that our industry
Yeah.
has. But if you contrast those two people, you might have someone who's just band-aid fixing things, sleeping in the maintenance shop. And the residents know that if they submit a work order, it's not going to get fixed anyway. So they just basically stop. And he's closing out work orders without completing correctly. On the other hand, you might have the person who just does an excellent job, repairs things well so they don't break again. He's avoiding long-term expenses and capital expenditures. He does a great job of making residents comfortable, so they submit more work orders to ensure things are not deteriorating. And so he has a slight backlog, right? Our industry will fire that guy because they think he's not good. And they will pay the person who's sleeping in the maintenance shop more. And, I was one of these people. I saw that disconnect. And I said, well, if we can actually just find a way to track this, we can acknowledge the top performer. And so we're tracking speed, we're tracking quality, and then we're tracking overall production and output. So we know data points, our KPIs that we hold our maintenance techs accountable to is, what is the average length of time a resident requested work order is open over a month's period? And we hold you accountable to that. We expect 48 hours or less, right? So some of them might go a little bit more, but a lot of them a lot less, but it prompts them to be responsive. And then we're looking at resident satisfaction surveys as they complete a work order. Appfolio sends a survey to give that satisfaction survey to the residents. So, like, how polite are you? How are you making them comfortable? And then we also track, those are the big ones, but number of work orders completed per day would tack on our quantity. So number of work orders, how fast you're doing work orders, and how satisfied are our customers. Those are the three KPIs we hold the techs accountable to. And then we put it on a scoreboard to show the team, here's who's performing the best in each of these. And we give awards on a monthly basis to whoever's performing the best. And those are the people that grow within the organization because they're simply reverse engineering the actions needed to deliver the feeling of home. And the outcome is significant, right? So in our market, C to B class multifamily, the average length of stay for a resident is about 2 years. Ours is 5, right? Across our whole portfolio, our average length of stay is 5 years. I attribute a lot of that to our maintenance team. The number one reason people move is because their apartment is broken. And so if you're responsive and you fix their apartment, they're less likely to move. And that trickles to the bottom line, which then impacts those financial returns. So I could go through every single role and tie it back to that, but that's one entry level position that has a major impact.
Oh, great example. And especially like the part where you're sharing how, like, people in the industry miss these small key things about how they judge people on what they're doing. I can tell you that happens a lot in the world of systems engineering and what they call agile software development these days, which I won't go down a rabbit hole with that too much, but I saw it in my time as a consultant and engineer in the 2015 to 2019 timeframe. And what happens is, if you're not familiar with it, agile development of software, it's basically incrementally creating software where you have a minimum viable product out to people sooner rather than later, and people give feedback, and then you improve the software and you keep going. But those projects are broken down so that engineers can do task tickets, right? And they have points associated with each ticket of what they have to complete. And a lot of times the more conscious senior engineers want to write the code in a way that's longer lasting, or they're solving big problems. They don't necessarily get rewarded for that with the way the systems are set up. And some younger engineers that are more into, like, making quick apps and doing things with modules and stuff, they'll come in and they'll rapidly do all these story points. It'll look from a macro perspective, for those that aren't analyzing correctly, like, you got these engineers over here doing a bunch of stuff, but they're not doing the stuff that matters the most. So I see that in a lot of different industries. So that's an interesting way you guys do that well, and it speaks for itself. 5 years instead of 2. I mean, that's, you're doing something right. And for a guy who wasn't a good student, and you're doing a lot of smart things. So I don't know if you kept brushing up on management stuff. I don't know if this is natural to you, or did you? If you can, how do you continue to educate yourself? Because you sound like somebody that got like a master's from Harvard in management.
Uh,
To be honest.
no, I mean, I just don't think well, before I answer that, I wanted to, something that came to my mind that I really wanted to say is probably the biggest positive impact of being able to acknowledge top performers, whether it's in your industry or mine, or even just this maintenance tech example, is people are smart and they figure out the organizations that are growing and acknowledge the hard work, right? So going back to that example, if both of those two hypothetical maintenance techs do not work at SNS, right? But the
Yeah.
guy who's just busting his butt and doing a great job hears about this organization that has the back end ability to track true quality maintenance techs, acknowledge and compensate them based on their outputs, he's going to find us, right?
Yeah.
And that's we as we've continued to grow and build more of a reputation in our market. I learned the other day, I think we're the fifth largest landlord in Cincinnati. Hopefully
Wow.
soon first, but with that reputation comes easier recruiting. And at the end of the day, again, it's the people that support the operations and the operations that support the financial returns. And so it's like this feedback loop of where we're making more money so we can pay better, which attracts better people, and round and round we go. But to answer your question, I was not a good academic student because I'm dyslexic. So
Okay.
reading and writing was not a strength of mine, which the entire academic system is built off of. And so, what I learned is my listening comprehension is really good. And being dyslexic and not being able to fit the mold of the education system, you get good at the things that I think are translatable to entrepreneurship, right? You get
Okay.
good at being able to convince people and build teams and understand them and problem solve for an alternative solution. And so I'll give you an example. In school, we had a take home exam that you could use your textbook, right? 100 question, or I think it was 200 questions. Um, well, I wasn't going to do it because I couldn't read the textbook well, right?
Hmm.
And so what I did was I emailed half of the class and said, if you do questions 1 through 100, I'll do 101 through 200. And then I emailed the other half of the class, said the opposite thing, and then I just exchanged them. Right? I did exactly what I committed to doing, but I used a team to collaborate to get the outcome that I was looking for, and I did great. And you do enough things like that, and you start to just kind of reinforce how to understand people, how to problem solve, and how to not fall into a path that's already predefined for you.
Yeah.
Um, so,
That's
I
great.
have since figured out many, many ways to overcome what I don't even know if I would label myself dyslexic anymore. I'm terrible at spelling. I don't even know where a comma goes anymore. But um, I have voice to
Great.
text. I can copy, highlight something and just let it read it off to me, and my listening comprehension is great. So, did I
Great.
answer your question, Jim?
Yeah, no, that was fabulous. Great story. You're like a Tom Sawyer. The Tom Sawyer example there of getting working with your peers. If you've
Mhm.
never seen the old movie of Tom Sawyer where he got everybody to paint the fence for him that he had to do by giving them exchanging an apple, and then continues the process until he has everybody convinced that they should paint the fence, and they're
Mm,
doing it for him and giving him things for the privilege of painting the fence for him. So I see
yeah.
some of that entrepreneurial spirit in your example. And I'll tell you, my mentor in this business, I could say now, with confidence, friend as well, John Bogdasarian, from a company called Permanis in Michigan. He was dyslexic growing up, and he said people treated him like he was dumb and whatnot. Now he's built multi-million-dollar business and started with small family and friends syndication,
Hmm.
and he's written a book called "Do the Work Once, Get Paid Forever."
Hmm.
And I see you're similar to him, overcame what was viewed in the traditional education system as limitation, but you articulate well in these concepts and obviously understand them. So it was more to do with that, which everybody's discovering now, that the public education system and how it was set up for years is like is not maybe what we need for the future as is.
Hmm.
There's lots of different ways to learn. So
Yeah, I think there's lots of different ways to learn, and I did well in wood shop. I just didn't do well in the academics, but I had really supportive parents that were great, and what they always reminded me is they said, you don't have to be an A student, but you do need to be a C or D student to get through. And what you're doing here in school is, they reminded me that what I'm doing is not learning about algebra or literature or whatever, biology. I'm learning how to get good on things that I don't want to do. And so they reminded me that over and over, like, what you're accomplishing is you're honing your skill on how to get through things that are challenging. And so,
that's
they
very
put it in a great light, and always framed it well, and were super supportive of me. And, I could have had parents that just went crazy because I was a D student, and they said, no, just, you have to pass, you have to get through, this is part of life. But, going back to the academic system, it's like, how I got through, a lot of times it would be labeled as cheating, right?
yeah.
But in business, it's called collaborating, it's called delegating, right? And so it translates really well, and just not to school.
Yeah, no, it was a great example. Yes, yes, and that specific example you gave would be considered cheating to all you
Yeah.
kids listening out there. So, tell me something bad. This has all been positive, but
Mhm.
you had to have a few horror stories given what you've done. I mean, you've mixed it up down in the trenches.
Mhm.
You, what's the worst deal you can share, or something you took a big lesson on and like, whoa, never
Mhm.
going to do that again. You must have had
Yeah.
one right now.
I appreciate the question, and I get it. I get something along this lines frequently, and I really do struggle with the question, because not because I haven't made mistakes, because I make them every single day. I think it's because my natural way of viewing mistakes is that it's a learning opportunity. And
Hmm.
so, like, I don't store it in my brain as like, oh, this failure or this thing. One thing me and my brother have done really well is what I would call asymmetric bets in business, right? So the downside is less than the upside. And if you make enough bets where that is true, you will realize both downside and upside, but the net result will be upside, right? And so we make mistakes every single day.
Taking
We are
yeah.
a student of the school of hard knocks when it comes to our business, right? We're just trial and error, figuring it out. Um, and so I think back to, a specific property that we bought off of a foreclosure auction. We didn't get to go inside of it before we bought it. Um, it ended up being, in hindsight, we should have torn this building down. Um, and instead, my brother and I, this is many years ago, basically rebuilt the house from the inside out. And it would have been far easier to just tear it down and rebuild a whole new house. And so if you were to do the math of like, how much did I make per hour over the 6 months that we spent on this project, it would probably be less than $1 an hour. But yet I still don't see that 6 months as like a failure, because I learned how to build a house, right? Like through
Yeah.
trial and error, and failing inspections, and watching YouTube videos. And then I took that skill set and built the company we have today on the trades that I learned. And so if you zero in on that specific deal and you say, what was the financial return? Oh, awful, right? If you're just doing financials. But I learned so much from it, and I certainly wouldn't get rid of it in my story.
Got it. Okay, fair enough. So you would do it again if you had to do it all over again. You would do it again because what you got, took a positive side out. Well, let me ask you about the asymmetric betting a little bit because you hit on something that I think I read in Tony Robbins' latest book, and I can't even think of the name of it now, but it's sort of the book is sort of a little bit of an advertisement for CAS investments, part of it, but it's the holy grail of investing. But one of the guys that he looks up to, essentially one of the, I think one of the most successful private equity guys of all time, actually. Um, I think he looks at each opportunity. I want to say 5x. It's a 5x opportunity, but if he loses, he could only lose 2x maybe or one. So there's sort of that asymmetric feel to it,
Mm-hmm.
separate from non-correlated assets, which I got a feeling you would understand and probably do with some of your investing, depending on what else you invest in. Um, break down that asymmetric a little bit for some people that might not know what you mean by that
I mean, I think,
approach.
as I said it before, it's the downside is less than
Yes.
the upside. So I don't have a
Okay.
specific weight, like you just mentioned, like 2x to 5x. I don't have that. And this could be boiled down into the smallest of things, right? Like, should we change our credit score, minimum credit score for applicants from 550 to 600? And it's like, well, what's the downside? Okay, well, we're going to squeeze our supply a little bit on our resident base. What's the upside? Our delinquency might go down by this much. And so
Okay.
then what we do, again, we're collecting lots of data. What we do is we look at all of our past residents. This is a real world example. So we look at all of our past residents and we say, of all the residents we accepted, how many of them are in the category of credit score of 550 to 600? And it's like, okay, that's 15% of all the residents that we've ever accepted into our portfolio. And we're like, okay, well, of all of our historical delinquency that we can then attach to a specific resident, because we're collecting all this data and aggregating it, we say, what percentage of our delinquency was associated with that same category of credit score 550 to 600? Oh, 60% of our delinquency. It's like the upside of wiping this
Yeah.
out is going to significantly offset any increased vacancy that we accrue from a lack of supply from this specific resident demographic. And so that it's simple, right? It's just like, that's worth it. And if you can say
Yeah.
that's worth it, you're probably making an asymmetric bet.
Perfect. Perfect example. So I guess I got to probably wrap it up with one more question here
Okay.
for both of our sakes on this Friday when we're recording. I want to circle back, I think, to finish off with how you view deals. Because you're in an interesting position that most people doing multifamily aren't in terms of how you're vertically integrated, how you're growing. You sort of have mostly a closed loop other than syndication money,
Mm-hmm.
which I'm guessing is you just take an LP. I don't know if you do co-GPs with people or not, but my point is, my question to you is, when you go to analyze an opportunity, what are key metrics you look at? Like mine, like when I came into this business, again, out of a totally different, I took my hobby and turned it into a full-time job, which I love doing, but I didn't grow up in this world of real estate. So I was kind of taught, like I said, from John Bogdasarian, I would say my main guy, of like, try to create a 200 basis points difference between going in and exiting, right? As a general rule. I know in value add, lots of times it's a forced appreciation. So I see lots of deals coming to me where it doesn't make sense. I'm like, why would I buy this at a 7 cap here when things are already trading at, 7.5? Like, it's not enough. I don't have the vision for it. How do you view a deal from a metrics standpoint in general?
Mm-hmm. At the end of the day, it's going to boil down to a target cash on cash return, excluding the sale proceeds, of 10% or greater.
Okay.
And an IRR of 12% or greater. Again, we're doing longer term holds. So our IRRs are usually not as attractive as someone who's modeling out for a 3-year flip. But that's not the type of investor we're attracting. We're attracting people who want consistent, predictable cash flow over the long term. Now, historically, we have just blown past those metrics. I think, not to take credit away from our team, but the market has been extremely favorable to us for the past decade plus. And so we have always done a good job of projecting realistically. And then the market, when favorable, pushes us past that. So we have typically, when we're deciding yes, no, those are the metrics that we can boil it down to. But that decision is, especially in value add, especially in the type of value add we do, is highly nuanced. So when underwriting, we're looking at every single account on the income statement, which, is 200 rows long, but even looking at between the lines, right? So when we analyze a property, we don't just look at how the current owner is operating it, because there might be opportunity that they're missing. We might be able to, during the renovations, convert the property from boiler heat, which is landlord paid, to individual HVAC systems in each unit, which is tenant paid. And that might not be on the current income statement, but what would it look like if we did it? How long would it take us to do it? How much would that cost? And when I say we're good at operations, what we're good at doing is maximizing the income statement for NOI. And
That's
so
the bottom line.
every time we go through an income statement, we're looking at what every single line, and then we're looking between the lines. What did they miss? Or what could we add in on this income side? What could we scrape out on the expense side? And just years and years of experience, we start to pick up on things on how we could do that better and better and better.
Wow. Okay. So people usually come in for a 10-year hold in general, like when you go out to people, or not a 5-year exit, like it's kind of common.
Yeah, no, we do everything we've done is 10, but what we've become known for is the infinite return model, right? So what we do is we buy distress, we force appreciation, then we'll strip that equity through a debt restructuring, whether it's a refinance or a supplemental loan. Historically, we've been able to return 100% or more of investor capital at that time through that debt restructure around year 2 or 3. And then we continue to hold, right? So we hold for another 7 years, producing consistent, predictable cash flow. Our investors still own the same percentage of the entity that they did when they came in, but they have all their money back out. So on a cash on cash return, mathematically, it becomes infinite. And then they just come back to the next deal, right? And we just churn
That's
capital.
Great. That's really ideal. Yeah, that's ideal. I love it. They've got to have confidence. Your investors have to have a lot of confidence that you guys, when you say this is the NOI, this is the operating, it's a level of warm fuzziness that you don't get with a lot of people because you don't know. So I see that being very good. And I'm assuming you guys do cost segregation and depreciation bonus on all these assets, right?
Yeah. I mean, what's really been a privilege is having a partner who's a CPA and understands how to maximize the tax code for us and our investors. And so, yes, we're doing cost segregations, bonus depreciations, and we're also have built into our construction process. There's a workflow that's pretty well defined within an app that my brother built to when the project managers are creating the scope of work and they're selecting that we're going to, say, replace the outlets, right? We're going to upgrade from almond to white. One of the outputs of that app is it's going to send to our accounting department how many of these components we have replaced so they can accelerate the depreciation, right? So we're going to maximize these repositionings to full capacity whether it's renovating and getting higher rents or also maximizing the tax benefits. But yeah, no, we feel very fortunate that we've had great performance, and the past 2 raises we've done have both been above $5 million. The most recent one, we raised that in less than 72 hours, and the one prior to that was 24 hours. And so it was like tons of repeat investors who just have a high degree of trust in us to say, if SNS is going to put their stamp on it, I want to be involved. So, yeah.
Fabulous. Well, hey, it's been great getting to know you a little bit, Jered, and talking through this. And we're very impressed by your company all around. You're running a tight ship, and I'll probably be hitting you up offline, asking you questions about stuff as I, especially next time I do something related to value add or trying to figure something out. So I won't try to suck too much of your time, but I'm definitely going to ping you, pick your brain on a couple things now that I know your expertise. So again, how can people get in touch with you? I mean, I know they just Google your name. Probably there's a lot of stuff out there, but what's the best way to get in touch with you?
Through our website. So our website is snscapitalgroup.com, and there's a contact us page there, and that will certainly get to me. So that would be the best way, but happy to help you, Jim, or any of your listeners in any way I can. So thank you.
Excellent. And you have any specific deals coming up that you're going to be looking for investors on?
So I closed 2 new communities on the 15th of August, which as of this recording is 6 days away. Those are fully funded. And so we're out there sourcing the next opportunity, looking for those good, value add plays with that infinite return model that we can execute on. But don't have them right now. It's the bottleneck in our business, and we'll continue looking.
All right. Thanks a lot, Jered.
All right. Thanks, Jim.
See you later. Hey, thanks for having me on. If anybody else wants to find out more about what we're doing, please come to froggycompanies.com. Check out our 3 different business areas. It's great talking to you, and see you next time.